just one day ahead of expiry. We are looking at some good recovery coming in. Some short covering also is not ruled out in financials right now. But overall, there's no clear trend which is emerging last couple of days. Broader markets are witnessing some activity. 31,000 is thereabout where the Sensex is actually just meandering right now. So let's talk about what sort of a portfolio approach a lot of professional fund managers keeping, and one such fund manager we have with us today. He's a market veteran, has been with reputed organizations like Citi, JP Morgan, etc. Worked globally as well as in India in his previous avatar, and of course in the last just over 1.5 decade has been a professional money manager at runs the firm Piper Serica. Abhay Agarwal, thank you very much for joining us on the show today. How's it for you operating your fund from home? How's it listening to con calls, webinars, and pouring into numbers?
Actually, our efficiency for the whole team has gone up because though we are at different places, we are all connected digitally through phone and internet. So we are able to do far more. Interestingly, people don't have to travel. There is lesser travel stress, higher energy levels. So we just want everybody to be safe wherever they are. And, for us, actually, the work is going on pretty well.
Abhay, I was just looking through your fund and you have a reasonable exposure to the area of financials. Now, the opinion in financials is quite divided, and some of the premium ones like Kotak's, HDFCs of the world are relatively way better off than others and are even witnessing very good response to big paper supplies as well, like the QIP. Whereas the darlings of the last years, Bajaj finances of the world, have turned cautious because of the change in environment. Where do you find better margin of safety? How are you analyzing financials? Because you have exposure to similar kind of names in your fund as well. Talk to us about your thought process there.
When we are looking at financials right now, our belief is that the balance sheet strength will be tested first. It's already getting tested. Second, the market is going to test very vehemently the risk management skills. So the large caps that you named, HDFCs of the world, Kotak, even I would say Bajaj Finance to that extent, who are focused on collections would be okay. But the smaller banks, the smaller NBFCs, and even the smaller banks where you can already see the moratorium increasing. There are some of the banks, I saw small banks who have said that 90% of their book has gone in moratorium. I think that's where the scary signs are, because with an extension of the moratorium to 6 months, all that has happened is that the defaults have got extended to 6 months, and we track the collections very closely. We have some good linkages into the industry through which we know what is happening at the collection levels. And the collection agents, collection companies are very worried that the ability of people to pay is at serious risk. So those banks and those NBFCs which have a very large, small ticket size, unsecured retail lending portfolio, I can say with a lot of confidence will have a very tough time in recapitalizing. Whereas banks like Kotak and HDFC will be able to raise capital. Even HDFC Limited, they don't have any balance sheet pressure. They have provided ahead of time. And also, they are the lowest cost borrowers even right now in the market.
Right. Fair point. Abhay, also there is one part of the market which is now perhaps getting overcrowded, or if not, but at least the consensus is moving towards it and finding some safety. That is the hospitals, the diagnostics, pharma names. Ownership is going higher after a 6-year kind of completely being ignored. How are you looking at this entire healthcare space? One. And what kind of exposure do you have? What kind of category do you have hospitals in your portfolio or pharma, MNC pharma? How do you recommend to be played this particular area?
Again, great question, because this is a space that we have been tracking very closely. We own Apollo Hospital, which is the largest hospital company in the country, and also a lot of people do not realize it is also probably one of the largest pharmacies in the country. And we also have Sanofi, which is the largest diabetic formulations company in the country. So if you step back and look at how healthcare has organized itself in the country over the last 10, 15 years, they were all separate moving parts. So you have hospitals on one side, you have general physicians on one side, you have pharmacies on one side, then you have diagnostics on one side, and the formulations, the branded formulations, the drugs on the other side. And none of these five parts really ever came together. They were all moving separately. They had separate stakeholders, separate influencers. So doctors would run the hospitals, pharmacies were run by pharmacists, pharmaceutical companies would run the pharmaceutical companies and decide which drugs to push out. MRs would go and tell the doctors what to do. Now, this COVID-19, what it has done is it has slowly and steadily ensured that there is a convergence that is taking place across this. So now diagnostics have to work well with the doctors and hospitals. The pharmacies have to integrate. So what we are looking for now going forward is that there is going to be a lot of convergence and integration of these different moving parts. So it will be difficult for a pure play path lab to stay independent as a path lab. So for large hospitals, like I said, Apollo Hospital is also one of the largest pharmacies. Nothing stops it from becoming the largest path lab also in the country, an independent path lab. So what we are going to see going forward is that the larger companies that can integrate the whole supply chain and distribution chain will get stronger and bigger. And the smaller specialty hospitals, specialty companies will have a tough time.
Right. Fair point. Abhay, how are you playing the consumer space overall? Again, there is a lot of comfort towards this area, but how are you differentiating between consumer staples and discretionary? What kind of themes are you finding comfort in this kind of an environment?
What is happening is that we are seeing it increasingly. What people thought are consumer staples are slowly becoming consumer, discretionary. People are now really trading down and thinking twice before spending even 1 rupee on a premium product. So before COVID, the whole thesis was of premiumization. And now, at least in consumer staples, we are seeing that premiumization is not playing out. People, if two products are available at the same time and one is cheaper and does 80% of the work, they will go for it. So the companies we are looking at, like Lever, Nestle, they are reducing the cost of purchase by reducing the sachet sizes, making sure that the product is widely available. The smaller companies are struggling. Again, we are seeing that they're not able to support the distribution chain. So if a retailer wants credit, more credit genuinely, the larger companies are able to provide that credit. The smaller companies are not able to provide that credit. So their products are, slowly getting out of the store shelves. And we think that this will continue to play out where the larger companies with better distribution and better adaptability will continue to gain market share. We'll see also some volume growth once the lockdowns are over. The smaller companies will have a tough time.
For a moment, let's just take a step back, Abhay, and understand your framework of how you are looking at the investing landscape, especially at a time when, reports like Crystal's just came in yesterday saying that the demand destruction would be huge. Almost 10% of the economy demand will be destroyed permanently. People are also talking about the U-shaped recovery, which may not be next few quarters away, but it could very well be over 12 months far out. So if 12 to 18 month period is being spoken about now versus just 1 or 2, 3 quarters earlier. So the entire narrative on how people are assessing the hit to the economy is getting changed. In such an environment, when would market, what are the indicators market would like to watch out for closely before any signs of a bottom in the market?
So as an investor, what I would like to see is that the lockdowns go away, the number of cases of COVID drop, the fear psychosis that people are in reduces. Most importantly, the number of job losses that have taken place reduce. People start getting back to jobs, because that will tell us that corporate earnings will pick up. Till then, all that we know is that earnings are going to be under tremendous pressure for 90% of the listed space. The 10% will benefit because, it is already prepared and strong enough to deal with this. It's like, COVID-19 attacking a body, the one which has higher immunity will survive. The ones with weaker immunity, which I would say are weaker balance sheets in this case, will have a very tough time. So what we are doing is we have raised our cash allocation. We are at almost 35% cash right now. And the remaining funds are invested in 10 or 12 companies where we can say with a lot of certainty that whatever happens, the earnings will still grow for next 3 years. So we're looking at a 3-year CAGR of, let's say, about 15% revenue growth. And rest of the space we are not looking at, because right now it is impossible, forget us, for the management to be able to say what kind of earning visibility they have in next quarter or next 6 months. Everybody is just guessing. But you're absolutely right. CRISIL kind of reports are good reports because they put out real data and they talk about 10% of GDP irrevocable destruction, which is $200 billion of loss. And out of that $200 billion is 150,000 crores gone basically from a large number of small and medium-sized enterprises who will not be able to open up. There will be tremendous job losses. So in a situation like that, there is no point jumping the gun. We are playing it very safe. I think that for a fund manager, this is a time to focus more on risk management rather than, calling a bottom and start or being very aggressive. So that is our approach. We are waiting to see how the earnings play out, confidence comes back in the consumer space before we start raising our allocation.
Abhay, one last question. You're running 2 funds right now, one the domestic PMS, and we understand another one now being floated and money being invited from your overseas entity, the offshore fund. Talk to us or leave us with some thoughts on the kind of conversation these ultra HNI clients of yours are having with you at the time that they are wanting to either invest with you or increase allocations, or even perhaps some of them must be scared about their portfolios and hence must be in discussion on what lies ahead. Give us a flavor of the chats you're having with some of the biggies.
So the big investors, I'm talking about the big family offices in Europe, Middle East, Asia Pacific, they manage their money in a very scientific, systematic manner where they look at allocation. So none of them were over allocated into equity. So none of them is very worried or losing their sleep. In fact, a lot of their investments in the US market have done well. And what they are looking to do is to now churn some of the US market equity money into emerging markets, especially India, because they think that their view is that, they have been so under allocated in India for the last 4 or 5 years. They do not mind coming in now, despite knowing that the market is expensive on a relative basis. So what our discussions are showing is that these guys are large investors who look only at top-down strategies. They don't want to invest in stock-picking strategies right now. They want to know what their money will be invested in, in a very transparent manner. They would leave the risk management, allocation management to the fund manager, but at least they want a comfort that, look, this is my strategy, so I'll invest only in large cap or industry leaders, and then you stick to doing that. So I don't think that they're paranoid or they're very worried. The deep-pocketed investors are looking at India, but none of them are going to come in with their entire wallet. If they have 100 to invest, they are looking at investing 25 right now and keep the powder dry for the remaining amount.
Right. All right, Abhay, we'll let you go on that one. Thanks so much for joining us with your thoughts on markets and investing. That was Abhay Agarwal of Piper Serica.